So with that in mind, from Jim's question last Friday, is this a good time to buy the VIX when the VIX was at 14? And, we talked about we looked for when the VIX was under 13, but we did answer that anytime you're worried about a hedge, worried about the market, or have a worry, it's a good time to put in a hedge, excuse me. So what do I have these two calls here for? Well, this is typically what I might look at. Now, with the closing values on Friday the 14th, the 25th of March, which was 40 days out in time, 18 strike call was the closest price to $1. It was a 95-cent bid, $1.17 ask, so a midpoint of around $1.06. The 16 the 16 call for March 25th had the delta of 0.3, but it was a price of 151. My approach, had I bought VIX calls on Friday as a market hedge, I probably would have bought the 18 strikes for a cost around 105, and depending on how much I wanted to hedge, I might have bought 5 contracts or so to put in a total amount value of around, usually I put in about $1,000, but since I split the two, I just 530 in one, 604 or so in the other for the total cost. Usually would have been around 9 contracts of this option here. And it did look like a good time with the events of the last 2 days. And of course, you see a profit here on this position alone of 65.6%, excuse me. So with the 10 contracts, it would have been about a $700 hedge against the loss in the portfolio, essentially on the spread positions, which all of my bull put spreads that actually did not expire today, they expire next Friday, are still out of the money by about 4 or 5% even with today's decline, although the Shopify one took about a 20% dip, or $20 dip today. And that came close to my, almost came close. It's still $10, $15 off of my trigger. I might look to roll that bull put spread with the market falling at this time. Okay, so as I said in the slide, sometimes I get egg on my face. I didn't say that to Jim that now wasn't a good time to buy VIX calls, but this is usually our approach. I didn't actually hedge. Sam had commented to me this week via email that he was looking at contra ETFs during the week, and of course late last night into this morning as well, which probably panned out. And on Friday, he also mentioned that he had purchased around purchased puts on SPY and SPX, but SPY at around 341. That's another form of a market hedge. So I just wanted to go over that real quick, just to have some fun with it. It was a good time to buy VIX calls, being able hindsight 2020. I wasn't in VIX calls, but I did have other hedges that were less, I don't want to say extravagant, but were less volatile, that didn't have as much of a spike, but still hedged to help the portfolio. Okay, Don asked a question via email just before the webinar began. And Don says, please discuss the best ways to approach the above situation. I bought Tesla, excuse me, at 474 and sold a 500 short call. So we have an in the money now covered call position. As we know, Tesla gapped up above 900, came down a little bit, and then went back up slightly again. So with volatile stocks as covered call position, would you set stops trades at or near the short call to buy the equity so you don't miss the significant upside moves? Well, there's a couple thoughts on this. And in general, Don, the answer to your question, excuse me, is yes. I would have an alert set in my power options portfolio to maybe roll the covered call position, in this case, if Tesla had moved up maybe above 510, 505, gone slightly in the money, I may look to roll it up. Okay, but that also depends on the original premium I received. It might be as high as 515 or 520, depending on which premium I took in originally and how much I reduced the cost basis on that as well. Okay, so let's take a look. I'm going to navigate over back to our other screen. All right. And here, of course, is the 2-month chart of Tesla itself. And it's almost hard to see where the 500 line is because it's way down here, and the numbers are on our axis here are so small, and this is the large screen. But here is our 500 line as a marker. So Don, to answer your question, when we purchased stock at 474, it's probably around this time frame, and you sold the 500 call. It looks like it went up to 550 the next day, almost hit. I was at 550. I'm sorry, 525 the next day. Went up to 550, pulled back a little bit, and then back up to 550, and then up to 600. So there's probably the gap you got caught in. And it's really hard to manage. But if you set a trading plan for yourself as far as a covered call position with a capped upside, even if after the first day you set a order or you set a alert to roll up your covered call if the stock breached above, let's say 520, 525, 515 even, follow your pattern. Do it on that first or second day to roll up. And even if you rolled up here to the 600 strike, you would have been okay for the next few days, and then it would have gapped up to about 650, and then you might have wanted to roll at that point. But you would have missed all of this. Regardless of how you rolled, once it hit that giant gap up from where are we looking here, 670 up to 760, it's probably too expensive to roll, and it's probably too deep in the money to roll anyway. And then, of course, it did come back down. So now here's buyer's remorse with the covered call strategy. We get in right about here at 474. It gaps up above our strike price, and we think, wow, I want to roll it after the first day maybe. But then it pulls back, we think we're okay, and then it does it again. So maybe we roll here up to this strike. Okay, so we go along, and by the way, we're probably 14, 20 days out in time in this case, so this is all happening before we're even near expiration. Haven't really seen any time decay in our favor. But we're chugging along here, and our strike's up there, and then gets close to it again, but not yet, and then this gap happens. We say, oh, I don't want to pay for it, it's too expensive. And this one happens, we say, oh, I don't want to miss the rest of this upside. I better roll this call from 600 up to 1,000. And then this happens. So that's a lot of the danger with trying to roll up the covered call in a volatile position, because now you're holding the 1,000 strike call. It looks okay now, but fell back down. You didn't collect $300 for this 1,000 call. In fact, you added to your cost basis. Your total cost basis is probably in the 940, 920 range. And then it falls back down to 750. So you're at a $200 loss when here you're at a good return. And even if you hadn't rolled the call, even here you were probably at a good 5, 6, 7, 8% return on the covered call position. That's roller's remorse, I guess we can call it in this situation. And the position might still look okay now back up to 900, but you might actually just be at a break even now or smallest because of the cost to roll the position. So what are the alternatives? Well, there's a couple alternatives, and let me check the questions here. I'm sure some feedback came in. Okay. Okay, Sam just offers comments that it's his, I apologize, this is my 11th week in Tesla bull put. So he was in a bull put, which has a capped gain as well. It's more of a leverage position. He's at 740 and waiting for another decline for doing other positions. Oh, yeah, and Sam, we'll talk about that in a moment too. Okay, so Don, let's get back to our conversation. The two approaches to consider in this, and let's just go to a custom spread position, and we'll just graph what could be close to your original position. There's no shame. You probably have a really good return on this, and as you saw, I don't think we wanted to necessarily roll this and get into roller's remorse again, as the price would have been too high. So what I'm looking for here is I'm just looking to see it's go up to the 700, 800 strikes, 900 strikes here, 70, 60, cut down about 20. Okay. Okay, so I think I have a good idea of what to expect in this case. Price-wise is what I'm saying. Okay. So let me go down to the custom spread, and we had a cost basis of, I apologize, 474 for 100 shares of stock. Sold the 500 call, and based on the numbers I saw, this might have been around $41, $42. The at-the-money 900 strikes right now are at 60, so about maybe half the price below. We might have dropped maybe 20, maybe 30 points. That might have been 35. We'll just try 35 for now for this call, which is on March 20, so we're about 30 days in time. Okay? I know these sorry folks, I know these numbers aren't yours, but I expect with the volatility of Tesla itself, you might have been looking at that time at a 8, 9, 10, 12% return on the position. This one's 13.9, so might have exaggerated the premium. But here I am, $360 in the money on my covered call position. What is one thing I might have been done to avoid this? Well, of course, you have to say, number one, volatile stocks, those above the average market volatility, might not be the best candidate for a covered call position. And the reason why is because you kind of end up in the, I don't want to say worst of both worlds, but you can end up in the worst of both worlds. Now, you have a great return, and even if this isn't your return, I'm sure this covered call was a really good covered call return. You're probably going to be happy getting assigned at 500 for this position, even though we have some regrets about missing the movement. But what ends up happening, if you're looking for covered calls with that higher return on more volatile stocks, and I see investors do this, they say, why would I sell a covered call on IBM 30 days out for a 2% return when I can sell it on this biotech stock that's only trading at $40 and get a 15% return? And that's because you end up with two scenarios long-term in that trading plan that don't work out to profit. Number one, you see stocks that move up 20, 30, 40, 50%. Okay, you only make the 12 or 15% return because you're capped, and now it's too expensive to roll to get that extra 7, 8%. And by the way, if you roll, don't really increase the return by 8 or 7%. You increase it by maybe 2 or 3% because you have to buy back this deep in the money call, spend a lot of cash. Yes, you're getting a new volatile premium, but you're adding to this absolutely, but you're not adding another 12 or 15%. It's going to be 5%, maybe 6%. But then the other part of those stocks, even if you put in a stop order at 5%, they tend to drop 20 to 30%. To the downside, some of the biotechs might drop 70 to 80 that are offering that 12, 15% assigned return on a covered call when normal stocks are offering a 3% return. And that's the danger because you are getting these gains of 12 to 15%. But if I put in a stop order here even at 10% and it blows through overnight, which tends to happen with these biotechs, I get filled at a 30% loss. I've wiped out 2 previous trades. And because of the way these positions are volatile, if 40% of the time I'm seeing these gaps and getting that 12% return if assigned, but not taking advantage of the other 8, 9% on the 20 to 30% movement, but on the downside, I'm taking 20 to 30% losses 40% of the time, and the other 10% of the time, it's little lost, little above break even, stays right around its price, I get assigned, and I make the 12%. So it's not really getting ahead long term. Okay, so volatile stocks might not be the key. You might want to do a different strategy that allows you to take advantage of direction one side or the other. Number two, since you own shares of Tesla at this moment, although you're probably going to be assigned, as you mentioned, Don, if you wanted to hold it long term, consider something we do, one of the quote-unquote riskless spread trades that we use in the married put radioactive trading techniques, meaning that you can still own the position. Of course, I'm protecting mine with a put. You're doing a covered call. That's fine. This isn't protected. Tesla's not protected with a put. That's okay. So we'll just ignore that. But you sold a call and you're worried about missing upside. Do you want to hold on to it, especially something that could gap? Well, what we might want to consider is buying an extra call further out of the money that leaves the upside open. In a sense, you're adding a bear call credit spread, so you're still getting a premium, not as high as just selling the call, but you're still getting a premium and you're leaving the upside open. Okay? So that might be another consideration for you to do going forward that at least would allow you to get more of this upside move on these volatile positions. So let's say when you bought the stock at $474, you sold the 30-day out 500 call for $35. I don't know if that's the right premium at the time. The volatility on Tesla might not have been as high when you sold it as it is now, but that's okay. Let's just take this example. And we'll go back to March 20th, and we sold that 500 And with Tesla, we might want to give ourselves some room for a good premium. So I might even have gone to, let's say, the 540. Now, it'll cost a pretty penny. We got 35 for the 500, might have been able to pay 18 or so, maybe a little bit less. Let's call it 15 at the time for the 550 call that was 30 days at a time. Sorry for the scrolling. Tesla has a lot of strikes. So remember, I'm selling the 500, buying roughly the 540. Let's put in a price of 15. Yes, I'm negating $15 of premium from the original call I sold. Here we are at this position at 1500. I'm sorry, yeah, 1500, but $15. And interesting, it looks like a nice straight line profit and loss chart. But let's see if I can do this here. What I really want to focus on is I'm going to do this with a lower price stock in a minute, Don. What I really want you to focus on is this area down here, because the stock had moved up so much, okay? And that area there, oh, it doesn't let me do it when I have the pen selected. That makes sense. Okay, let's see here. Sorry about this, folks. It'll be right, there we go. Okay, so there we go. So I just increased the screen as much as possible. So what we did here is you did a bear call credit spread on the stock. Here's your covered call at 500. And here's the long call strike at 540. So you're looking at a much better run-up in this scenario. Doesn't mean every position is going to turn out better because you are giving up some premium to buy this extra call. But what does it do? Essentially, you have a bear call spread with an underlying stock. So if it moves up, you lose on the bear call spread, but the stock is free to run. Or you have a covered call, which you have, with an extra out-of-the-money long call that you were paid to own because it was less cost than the call that you sold, and that has the advantage to continue upwards. It's what we call income method number 6 in the blueprint for the radioactive trading techniques. Gives us the benefit of generating premium like the covered call, but it leaves the upside open in case of a large gap or a large run in price. I am actually in an income method number 6 position on my Yandex married put trade, which of course pulled back with a lot of other things today, but I've lowered the risk, already bulletproofed the position. The bear call spread is likely going to expire worthless next week, 28th? Yes, on the 28th, yes. So it's a good position to use. It's an idea for covered call traders when you're in a volatile stock and you've got some good premium, but you might not want to lose the stock. You have a feeling it might swing wildly one direction or the other. Well, you might have a stop in place, but doing this bear call spread, adding that extra long call, allows you to still have further upside on the position. You don't want to get too complicated with it. You could add other legs to it, or buy another call here and sell another call here to give a little bit more premium if it really moved up, or ratio call spread in this situation, which would give you more but would still have a capped gain. But if you had 200 shares, you might be able to buy one call and sell two. Now you've got a covered call on 100 shares and a bull call debit spread to give you a little extra oomph, and it would leave the upside open. That's a little more complicated. I think this is a better way to go, to leave the upside open, but still taking a premium to hedge your stock position, lower your cost basis. Okay, let's see if I can get us back to normal. Help if I'm here. All right, so now in most cases you don't see a gap, of course, of 200%, I'm not 100%, 80%, 70% in a 2-week period, but Tesla did have that. Okay, let's take real quick, just to show you a better example of this. We're going to take another stock. I'll try it. Sam had, this was the comment I was laughing on. Last week we were talking about some positions, and Sam emailed me this week and was talking about straddle positions, and one of my earning straddles was on Domino's Pizza, which at the time, it moved up about 70 points. So it was around 280, 295, I think, and it gapped up to about 370 or so. Okay, so let's say I was considering an out-of-the-money covered call on Domino's Pizza. Buy it today, 100 shares, roughly at the current price, and we're going to go ahead and sell the 380 call couple weeks out in time, 14 days out in time, March 6th. And we don't get a great premium for this 590, but that's okay. So 3.8% covered call return. Very common, lower volatility, quality stock, good target, doesn't have a tendency to gap. I'm not saying trade covered calls around earnings or doing any kind of thing with a capped gain and a huge loss, a capped gain in one direction and a potential for huge loss in the other around earnings. This isn't the structure we use around earnings. So I like the stock. I want to hold on to it. I'm going to manage it if it gets to 382, 383, maybe, or since I collected only 595, I think about half of that, right, 285 or 290, let's say 3. Goes up $3 above my strike at 380. That's when I might look to roll the position, maybe go up to 385 or the 390, depending on my time frame, how much time is left, and if I got any time value decay on the position. But if I was worried about a gap, I was worried about the potential for further influx of capital after the strong earnings report, I may consider taking half of that premium, the 590 at midpoint, which again would put me at about 285 or so, but maybe I'll go to the 395. Maybe I'll use less than half, and I'm going to buy the 395 call for about $2, $1.90 or so at midpoint, but let's go ahead and call it $2. So I'm still getting a 390 premium on this position at the 380 strike, out of the money, but I'm going to take some of that away to buy the 395. How's that going to look? Okay. So this is what I was trying to show you. I still have a capped gain in this range, but that's okay, right? I mentioned 383. I might roll the position down, and if it goes higher, I probably would have already rolled at 383, even though I'm in this structure. If the stock does move up, remember, I'm holding the 395 here. But if the stock moves up to that 383 or 385 mark, the next strike, I may just be able to roll this short call. It might do a little bit of this, but I still have that unlimited upside going forward, right? But I'm still trying to keep it from being assigned. But if it did gap up to, say, 410 or 420, without management, I'm up in this range. I'm okay with that. I might just take the loss on the bear call credit spread here, or just roll the short call and leave this long call open and still treat it as an out-of-the-money covered call. And if something surprised me on Domino's Pizza, and like Tesla, within the next 10 days, going from 500 up to 750, this goes from 370 up to 520, I'd still have that upside open. That's what it looks like when you add the bear call credit spread to a stock position. So it's another thought to do it. But on these long, these volatile positions that you want to hold on to, this is a good approach. Okay. Oh, Maurice has a comment. Says, what do you mean by roll? I'm new. Okay, so rolling is done in any option strategy whenever you sell a call as a covered call position, sell a naked put, and you want to roll the position as well, and beyond. But even if you're just in a long call, you could consider what's called rolling it up and down as well. Rolling means you're going to buy back the obligation. So in this covered call, Maurice, I own shares of Domino's Pizza at 371. Let's take a different quick example here on this covered call position. We're going to take off the income method. We're going to take off this bear call spread entirely. And we're going to say we had a cost basis of 340 on Domino's Pizza. And at the time, I had sold a 14-day out, 340 to 350 call at the time, which was out of the money, Maurice. And let's say we got a little bit less than we would see for that 375 strike. Let's say we got $4 for this premium. So I bought shares at 340.96 after the first pop of earnings. I immediately sold a 350 call. Again, not something I maybe want to have a capped upside with on a moving stock after a really strong earnings. Okay. And there we go, 3.9%, still about the same percentage return. Now, Maurice, what am I at? Anytime between now and March 6th with this movement upwards, I can be assigned at my strike price at 350, now that the stock has moved up to 371. What I may consider doing in this case, I want to stay in Domino's Pizza. I want to take advantage of this $21 or so, if I can, that I missed because of my obligation to sell shares of stock at 350. So what can I do? I can roll the call. What does that mean? It means I'm going to buy to close my 350 call for a much higher price. I'm going to cancel the obligation I have to deliver shares of stock at 340. And I already collected $4, and this is going to cost me about $24, $24.50 to buy back this call. Okay? So we're going to simulate buying it back. So I have to buy to close that call position. Midpoint 24.50, 24.60. So what did that do? Remember, I bought stock at 340.96 and sold a call for 4, so we knocked our cost basis down to 336. Now I'm adding back into the cost, so my cost basis is $361.56. I increased it by 20 points and 60 cents. Kind of easy math there. $4 premium in, buy it back for $24.60. Now, what am I going to do? I'm going to roll. I'm going to roll up in strike because the stock's now at 371. So I might look at the 371, the 380 call we just looked at perhaps, maybe the 385. But I'm likely not going to go to March where I started because I'm not going to get $20 for that call. I'm probably going to have to roll out in time if I want to roll for a credit. What does that mean? It means I want to get at least close to $20 here, $24 to roll for a credit, but keep that higher strike. So I'm rolling up from my March 340 call to, let's say, probably got to go to June, but let's go to May. To a May, not quite, May 380 for 1790. All right, I'm going to have to probably go to June. I'm not going to September. I shouldn't even go to June. Okay, so we'll go to the 380 here, which is 2030. So that's about the loss I have, right? I've not a loss, but I've added $20.60 due to the buyback cost. I'm going to move the call up and out in time. So I bought to close my 350. I'm going to sell to open a June 380, going out 119 days, but it only increases it from 3.9% for a 14-day trade to 11.1. Okay, so that's about 3 times. We'll be nice and say that's 3 times the cost, but we went from 14 days to 119 days. So we only increased it by 3. We only increased the percentage return 3 times by having to move out 10 times more, from 14 days to 119. Now this looks skewed only because it's looking at calculating the profit and loss on both the near-term expiration of March and the June. To clean that up, I'll simply just clear this out. And remember when I closed that originally, we saw our cost basis was $361.56 due to the extra $20 there. So the true hockey stick covered call graph is here, 11.5%. Maybe I put the wrong price in slightly, but that's okay. So still a good return, but what did I have to do? I had to pay to roll the call. I had to move it further out in time, so now I'm sitting on this covered call for longer to get the time decay. Now that I'm in a June option, the time decay of that premium is not going to start working in my favor until I get real close to the expiration date. All right, Maurice, so that's rolling. And you can roll a call. If you just bought a call and it moved up and you want to take some of the profit out as well, you could do that. That would be rolling as well. And naked puts, part of a diagonal calendar spread where you buy a long call and you sell a call and it moves above the short call, you'd roll it just like a covered call. You may also roll down if the stock falls. And the great thing, of course, about some of the power options portfolio tools is that when you have a position, whether it is a long call, a covered call, naked put, credit spread, any strategy, you can go into the position analysis view. It'll give you a breakdown of your current position. And if available, it will show you rollout opportunities based on the criteria we use and suggestions from Power Options subscribers over the years. Okay, let me see if I have another one. Oh, let's check this one. Just as it's a married put rather than that. Shopify is still up. I'm holding the 380 put and it's at 520. Okay. So let me just show you. This is what a rollout opportunity might look like. whether I'm tracking a covered call, married put, long call, again, Maurice, position actions, position analysis. We get a breakdown of our current position. And there we see rollout opportunity. So this is a little bit different, but it shows me I could sell a call now to generate premium to bulletproof the trade or increase potential profits. If I was in a covered call right now and we link to this, it would show us the before and after picture of rolling the covered call position from my current position to the new position, where I can see a before and after graph of the two trades as well. Okay, that's what rolling is. It's very important. On that note, very quickly, I've got some customers. We've got some questions that came in. Fernando had a comment. I've got to go through Sam's, and Gary's been waiting patiently. Gary, I'm going to get to you in 2 minutes. I'm sorry, Maurice. And also for Don, later on, you can go to our YouTube channel on Power Options. Just go to YouTube, search for Power Options. And you can just use the search function here. Yep, and already kept it for me. So just use the search function. I'm looking for rolling covered calls is what I typed in. So okay, so here's one we did 5 months ago. It's only a 10-minute video, when to roll an in-the-money covered call, Maurice. So this will give you some insight also on the rolling. And this is a discussion similar to one we had today, Don, about looking at when we would consider to roll a deep in-the-money covered call, how to evaluate whether to roll the call, take assignment, or other options as well. It's a quick 10-minute video for you. Go to Power Options on YouTube, and then use the search function there for rolling covered calls. That one will come right up. And here's another example of rolling up a covered call. I don't think this one was as deep in the money. And there's some other concepts here as well. But those first two, a 10-minute video real quick, an 18-minute video. But for Don, this first one here, 10 minutes, really going to be strong for you, even though we spent about 15, 20 minutes on discussing it today for your exact position. But this one has a little bit more in depth into it on the concepts of planning to say, now that X has happened, maybe I missed it, when should I roll? What is my considerations for whether to roll or not, take assignment, or other options as well?